Hi, my name is George Dagnino. I'm the editor of the Peter Dac portfolio. In my reports, I talk about two main subjects, the long-term strategy and short-term tactics. The short-term tactics, by the way, are working really well, our short-term trading. But this video here is about the big picture and what is driving the markets. Since September, October of last year, the markets have been going nowhere, basically, if not down. Why? People say tariffs, people say it may be the war in Ukraine and the Middle East, but really it's all about liquidity. And this is what I would like to show you because liquidity right now is telling a very important story. The message of the markets is that what we are seeing today, or what is happening in the stock market, is caused by the tariffs this program or the other program, or what he says or what he doesn't say. But the bottom line is that really the markets are behaving like this because of changes in the growth of liquidity. And this is what the next two slides are going to suggest. Now, this slide shows two lines. One is the growth of the monetary base. The second line, the red line, is the growth of the stock market of the S&P 500. The monetary base is the money that is between the banking system and the Federal Reserve. What money is sloshing around in that area is called monetary base. It's not money that is going into the economy. It stays there. So the blue line is very interesting to follow because, as you can see, here is positive, then it slow down, then it's contracting, then it's growing faster, and now it's positive. The money supply is soaring, growth of 50-60% unheard of, which caused a lot of inflation eventually. Here is slow down in 21. In 22, it contracted, growth was negative, which is why we had a bear market in 2022. Then it started expanding again. In 2023, 24, we have growth in a monetary base, and then here the contraction. As you can see, the stock market, the red line, follows quite closely the growth of the monetary base, slowing down here. The bear market in this in 22, soaring 23, 24, and now is taking a dive with monetary base now contracting. So the monetary base is saying what you see is not the political environment, but is actually the lack of liquidity, the drainage of liquidity in the system. And as long as the monetary base growth is in negative territory, like in this period, the market, you cannot expect the market to be soaring as in 23, 24, quite the opposite. And this is exactly what has been happening in 25. The money supply, the monetary base has been contracting, and the market has been volatile and then has been contracting. Now, this is one measure of money, of liquidity, is the monetary base. There is another measure that is also very important that we should consider. This is a chart I did not believe when I constructed it. I wanted to see what is the effect of interest rates on the money supply. The money supply M2 is the green line. The growth, the soaring after COVID, the slowdown, and now is growing again. M2 is not related. It's not as related to the stock market as is the monetary base, the one I showed you in the previous graph. M2 is more related to business and also to eventually to earnings growth. So, for instance, the important thing of this measure is that when it's growing around 5-6%, like in this period here, you have inflation between 0 and 3%. When you have money supply growing above 6-7%, going up to 25%, you know, as in the 70s, that you're going to have a lot of inflation. And So the important thing of M2, it is when is between the growth is around 5%, 6% or lower, you have decent growth in the economy, probably growing at potential with almost 0% inflation, which is what we had in the 90s and after 2010. So now the money supply M2 is growing. Why? Because the banks, this is the money that the banks create. This is the business is growing, so they go to the bank and they borrow money. The banks take their money, that the monetary base, part of the monetary base, and they lend it. So by lending the money to business, business go to deposit in another bank, the bank takes that money and lend it again. So there is a multiplier effect, and that's what M2 is all about. So M2 gives you an idea of what the economy is doing. Okay, this is very important. Now, right now, the M2 is growing at 3.9%, 3.5, 3.9. So it's not growing very much. So the growth, what that tells you is the economy is growing around 2%, more or less, plus minus some a little number. So I'll say around between 1.5 and 2%. That's fine. So the next question is, what is the growth of the money supply is going to do? That was the question that I asked myself. Now, this is the interesting thing. Now, you got to be patient and just stay with me. What I thought is that the money supply also depends on interest rates, but not on the level of interest rates, but on the change of interest rates over the last 12 months. So if the change of interest rates over the last 12 months declines, the odds are that business improves and there is more growth in the money supply M2. I mean, this is nice to say, but I had to figure all that out. So what I did is I took the 2-year treasury yields and I computed the difference between in the last 12 months, the change in interest rates, and I inverted it. So that when this blue line increases, this is the change, okay, this blue line here. But I inverted it, meaning that in this period here, interest rates were below the level of last year. This is where getting below the level of last year. Here they were getting below the level of last year. So when you see a rising blue line, means that interest rates are declining relative to 12 months ago. Again, it's an inverted series. And what is interesting is, that this is what blew my mind, is that really it leads the money supply. There is a whole reason for it, but if I start talking, I'm going to probably lose myself and lose you as well. So let's say that's a fact. So it leads the money supply. So here declining means that interest rates are rising relative to last year, and the money supply is slowing down. Then the growth, the interest rates rose slightly relative to last year, and the money supply slowed down. Here interest rates declined relative to last year, and the money supply soared. Here interest rates rose relative to last year, and the money supply slowed down. Here interest rates declined relative to last year, and the money supply soared again. So why do I say all this? Because if interest differential between interest rates between this year and last year stay roughly the same, the money supply is not going to grow very much. That's what that chart is saying. And if it doesn't grow that much, the economy cannot grow very well, cannot be strong. That is, you can stop this chart, think about it, but that's what that chart is saying. So if interest rates, that's the conclusion of this chart. The money supply is going at 3.5, 3.9. But since interest rates are roughly the same as of last year, the money supply will not grow very well. So it's going to grow, say, at 3%, 3.5%. But this means that the economy cannot grow more than 3.5%, which is growth plus inflation. So it's going to be very slow growth. That's the bottom line. So this chart is saying yes, the economy is going to be okay, but it's going to grow very slowly. A little bit like, it happened here in this period, 2012, 14, 15. You see, the differential was very low, it didn't change much, and the money supply steadily declined in the economy. Inflation was 0%, with the economy growing at around 1.5%, 2%. So this is the message. The monetary base is saying that the market is going to be weakening, so that's in a way is consistent with the fact of what is said in this chart, which is the economy is slowing, it's going to grow very slowly, which means earnings are going to grow very slowly. I have another video, by the way, which shows that earnings are already 0% year over year and probably are going to decline in the next several months. So this is not an environment for long-term investing, and that's why I switched my recommendation to short-term trading. The next chart is going to put things even more into perspective. Okay, this strategy matrix is what really is a simplified version to look at the business cycle. In my business cycle, I have four phases. Phase one, the economy comes out of a period of slowdown or recession. Phase two, there is strong growth. Phase three, there is inflation, and therefore there is a slowdown. Phase four, in interest rates are rising and inflation is rising. In phase four, there is a economic contraction of very slow growth, enough to bring inflation and interest rates down until consumers have the money, feel purchasing power improves, they start spending again, and you go back in phase one. Okay, all this story is summarized in this matrix. We divide the matrix in the horizontal line in growth rising and growth declining, inflation declining and inflation rising. So in what phase of the business cycle are we in? Well, if growth is increasing and inflation is still dormant, then we are still in phase one, because the economy is coming out of a period of slowdown. In phase two here, you have growth that continues to improve, but now there is inflation rising because now the demand is very strong, there is a strong employment, so you have inflation going up. And so you're in phase two. In phase three is when now growth is declining, but inflation is still going up, and this is where consumers lose the purchasing power. Sales slow down until commodities peak and interest rates peak. In phase four is the corrective phase. This is when growth is down and inflation declines. Commodities are declining, interest rates are declining. This is the cleansing times, if you wish, of the economy, where all the excesses are being corrected to prepare for the next phase, which is phase one. So depending on what you think we are in the economy, you have also the strategy. Clearly, if you have growth growing with low inflation, cyclicals are likely to outperform. Inflation rising, this is phase two. Still, cyclicals are very strong, commodities-based industrials. But when it's become in phase three, when demand starts slowing down, you're beginning to switch to defensive sectors like staples, high dividend yields, utilities, and healthcare. In phase four, probably the best place to be is in cash and bonds, because interest rates are coming down, earnings are coming down, the stock market is coming down, and therefore you have to be very defensive. Of course, your question is, where do I think we are? Well, I think we are transitioning between 3 and 4. As I said in a previous video, earnings are already not growing. Our cyclical business cycle indicators are still contracting, so that means earnings are going to decline. Inflation is coming down, interest rates are coming down, commodities are weak, crude oil is weak. So we are slowly moving from here to here. So the strategy is going from this kind of investment to this kind of investment. It doesn't happen overnight, but it does happen. At the Peter Dax Business Cycle Academy on patreon.com/Peter Dax. We have 3 levels of membership, videos only, membership number 2, videos plus financial and economic updates. On membership number 3, we have our report, which is 22 pages twice per month. And we have videos, model portfolio, both computer generated and the short-term trading systems with market updates. Thank you very much for following this video. I really do appreciate it. Please send me your comments if there is any specific subjects that you want me to tackle. But in the meantime, thank you, and I hope to see you very, very soon. And of course, I need to remind you there is much more details on www.patreon.com/Peter Dax. Thank you, and I hope to see you really, really soon. So long.